what's been going on in Japan. Obviously, the Bank of Japan allowed their 10-year bond rates to reach 0.5%, up from 0.25%. And there was also talk about this on Twitter. Obviously, most of it I didn't really understand or why this was important. Can you talk about what happened?
Yeah, so I think first we have to go back to what they were doing before this announcement. And so Japan's doing something called yield curve control. So normally central banks control the short end of interest rates, like they'll determine overnight lending rates. But the longer term bond markets, like a 10-year Treasury, a 10-year gilt, a 10-year JGB, it is supposedly set by the market. Right, so the government's issuing debt to finance itself, and then the market is pricing that. However, in very indebted countries, as long as that debt is denominated in their own currency, which is the case for developed countries. That's kind of the key differentiator between developed and developing countries in a market sense. As long as they're in that situation, they can override the long end of the curve too, not just the short end. It's considered more extreme policy. And a famous example that I like to point to is back in the 1940s. During World War II, a number of countries did it, including the United States. So in the United States, we're fighting World War II. Our fiscal deficits were absolutely massive. A lot of people envision that's being spent overseas, but a lot of it's being spent domestically. You're building manufacturing. You're hiring people. You're sourcing raw materials, and this is very inflationary, big expansion of the money supply. And so the inflation in the U.S. averaged 6% per year. That decade, from let's say the early 40s to the early 50s, and the highest inflation print was 19% year over year, and they just held bonds. Like the short end of the curve was held near zero, and then the long end of the curve was held at 2.5%. And so the entire Treasury yield curve was submerged well below the inflation rate, no matter how high inflation got. And the way that they do that is the central bank says, we'll buy every bond that tries to go over this yield target, which is another way of saying, because when yields go up, it means bond prices go down. It's another way of saying that if bonds go below our price target, we will buy unlimited bonds to get them back above that target. And that also, what that does, that makes the private market want to do it for you, because if the Fed says, okay, we'll buy any bond that goes over 2.5% for more than a couple of days, and let's see, during a middle of a day you have a bond go up to 2.6%. Well, then maybe J.P. Morgan wants to come in, buy the bond, and then they can resell it to the government the next day at 2.5% and make a little gain, right? And so it's almost like it can hammer itself down, because they know if it stays above that limit, the central bank will come in and just buy it back down to that limit. And so it's reliant on the credibility that the central bank's actually going to do what they say. They don't want to be left holding the bag if on a random Tuesday, the central bank says, actually, we're not going to do yield curve control anymore, right? Because then all the people that were holding bonds get screwed. So anyway, with Japan, because they're in a very high debt situation, right? So when you have super high debts, 100% of debt to GDP, 200%, that's just the government debt. In Japan, it's over 200%. If you do the calculations, if they had 3% interest rates, 4% interest rates, how much of a percent of GDP would that be in interest every year? It'd be outrageous. And so they're kind of stuck in a similar environment where they're holding yields really low, and they were holding them before at 0.25%. So they were willing to buy any 10-year Japanese bond that tries to go over 0.25%. And so essentially what happens is most of the market just sells the bonds. Other than certain pools of capital in Japan kind of have to own bonds, big insurance, pension, things like that. But if you're not like a forced buyer, essentially, if you have alternatives, you get out of Japanese bonds, and essentially the Bank of Japan ends up owning half of them, and the market becomes very thin and rarely trades. And also it means that if the market is not allowed to express its view on inflation and appropriate interest rates through the bond market, they will instead get out of the bonds and sell the currency, right? So it ends up being expressed on the currency instead. And so you had an unusually weak year for the yen, because they were the one central bank that was really kind of doing hard yield curve control at super low rates, while the rest of the world was trying to tighten. And what we saw in the past week here was that the Bank of Japan adjusted their yield cap from 0.25% to 0.5%. Which doesn't sound like a lot. It's still below the inflation rate. It's still unusually low compared to what you can get in most other developed country bonds. But it is a big percent increase. And it also, it goes back to that point where you spook the private market that's supposed to be doing the yield curve for you as much as possible. Because now, if a private entity comes in and says, well, I can just resell this to the Bank of Japan, you never know that, Japan could come out and say, actually, it's 0.75% now. So, right. So that it's kind of harder to maintain a second target. And so it's kind of a trade-off, because one thing I actually argued earlier this year was that Japan set the peg too low, right? I mean, you could argue that they shouldn't have a peg, but realistically, when you have debt to GDP that high, they're going to have a peg. And then the question is, where do they set it? And I think that they set it unusually low, because it's very hard for them to maintain it that low. And I think they're kind of adjusting back up to a more maintainable level, but they have to reestablish credibility, because people can say, well, if they changed it once, why can't they change it again?
Right. So if they're doing yield curve control, that is to protect their own debts from seeing too high an interest. But how are they therefore buying all of those bonds to maintain that yield curve control? Is that not just more debt?
So they're creating new bank reserves to buy them. So debt is being issued as long as the Japanese government is running a significant deficit, which they are. So that's where the debt creation is coming from. And then the money to buy that debt it's not creating debt, it's just creating new money, right? So the risk there is that it can be inflationary. And so basically more of that debt is being converted from being held by the private sector to being held by the Bank of Japan. They're printing money to buy them. So it's essentially debt monetization. And the challenge in that environment is that basically they're saying outright that we need our bonds to lose purchasing power for the math to work, right? So Japan has an official 2% inflation target. Inflation's currently above their target, and yet they're saying we're going to cap yields at 0.5%. And the short end of the curve is at negative 0.1%, I believe. So it's the last remaining negative nominal yield. So when you look at the whole Japanese yield curve, it's submerged below not only the current inflation rate, but their target inflation rate. So if you add everything together, they're saying, wait a second, you want bonds to lose value over time. And then, yeah, the answer is yes, we do, because you can't have 200% debt to GDP and have positive real returns on your debt. Basically, those bondholders have to be the bag holders. So you have to, that's the situation we find ourselves. That's kind of peak fiat. When you're this far into the system and all these debts have built up, that's kind of the release valve that you get to.
But then who's going to buy these bonds? I know you say some people have to because they're mandated to, but outside of that, who would want to buy these bonds?
Very few people. There are days where Japanese 10-year debt does not trade, which is remarkable. These markets are supposed to be very liquid, but in Japan's case, because it's been such a managed market for so long, that the market has basically left. And so other than pools of capital that pretty much have to hold it, and the Bank of Japan, there's really few buyers. Now, some people might go in for a trade if they think, something might happen in a near term, but there's very few pools of capital that want to hold these things for long periods of time, because you're being told up front, we're going to do everything in our power to make these lose value slowly, right? And so most pools of capital do not want to hold them. And so the biggest buyer ends up being the Bank of Japan. Basically, the central bank owns the debt of the government by creating new money to do so. So it's this big, like, recursive, turtles all the way down fiat situation.
Is there any way out of it for them?
So the short answer is not really. If you go back to the 1940s, they were effective at inflating the debt away, right? So they, let's say the United States, we got up to, over 100% debt to GDP. We did a decade of roughly of yield curve control. Inflated the, basically nominal GDP grew much more quickly compared to the yields and the debt, and they're able to regain control of the situation and get the debt to GDP down. But that came from a number of factors. One, the debt was partially inflated away. That was a key variable. But then also, they were able to shift from, large fiscal deficits to austerity, right? And because a lot of the expenditure, obviously in the 40s, was temporary and, could be ended as you got into the 50s. And so the United States, it's not that they started running surpluses and paying down the debt, but what they essentially started doing is stop running deficits, at least. So for several years, they kind of held nominal debt flat while nominal GDP kept growing, and the combination of those bonds losing some of their purchasing power and getting control of that deficit situation and having growth come back was able to get them out of that trap. But that was kind of the best case scenario. If you looked at bonds for other countries throughout the world from the 40s, the United States was the one that was virtually untouched by the war. And so they came out strong. Their bond market lost less of its value than the rest of the world. The numbers were far worse in Europe. Japan basically hyperinflated. If you're on the losing side or the less winning side of that whole global conflict. And the difference now is that in the 2020s, a lot of these are structural. A lot of them are aging demographics, built-in entitlement systems, promises made, 1, 2, 3, 4 decades ago, if not more, adjusted along the way. And so, there's really few ways out other than trying to have it be a slow bleed rather than like a rapid all of a sudden, right? So they want essentially, if you got like a central banker drunk and you got them to be fully honest with you off the record and say, what do you actually want to do? They essentially say we want, yields below inflation, for like a decade and hopefully not, double digit inflation. Right. So it's like they want that kind of like sweet spot. They want to be able to maintain that. But of course, that's challenging to do.
Gosh, is there anything here that's repeating now? You said that the U.S. bonds were largely untouched now, with U.S. interest rates quite high. Are the U.S. bonds seen as like a safe haven right now?
In a way, but if you look at so it's funny because a lot of people when they think the dollar is strong, it must mean that a lot of foreign investors are piling into treasuries. But usually, you actually get the opposite. When the dollar is strong, usually fewer foreigners are buying treasuries. And it's because there's kind of these mechanistic forces there where the world has $13 trillion in dollar denominated debt, and when the dollar's strengthening, it essentially means that their liabilities are hardening, right? So, for example, if I took out a mortgage, but instead of being dollars, it was priced in Swiss francs, and the Swiss franc like appreciated compared to the dollar, compared to like my dollar based income, that would have been a bad trade on my part, right? My liabilities are like hardening compared to my assets, compared to my income, and that's essentially what happens in a lot of countries around the world when the dollar strengthens relative to their local currency. So compared to their cash flows, compared to their asset prices, their debts are hardening. And so what a lot of times happening is there's a dollar shortage in those countries. So they go to their central bank and say, look, we got to have dollars to service these debts. Our quarter after quarter, some of these come due. We have to pay interest on it. We need some dollars. So the central bank says sure, and then they sell some of their treasuries, and then they loan out dollars to their local banking system that can then loan it out to their non-bank corporations and so forth. And so usually if you have a sharp rise in the dollar, you get a reduction. It's flat to down in foreign treasury holdings. And so this has kind of been a year where there are some private foreign pools of capital that have been viewing the treasury as a safe haven and kind of going into it. But that's been offset by the fact that official sources like central banks have generally been trimming their treasury holdings for a number of reasons, in part because of that strong dollar environment.